Looking beyond tariffs, a busy earnings season continues this week with Magnificent Seven names, Alphabet and Amazon reporting results on Tuesday and Thursday. Here to discuss, we've got Mark Mahaney, Evercore ISI Managing Director and Head of Internet Research. Mark, it's good to have you on the program here with us this morning. You know, as you look into the magnificent earnings this week and what these two particular companies are set to tell us about the health of the Mag 7 trade, what are you going to be listening for?
I think three things. First is whether the DeepSeek implications or whether there were any DeepSeek implications. A week ago, Meta's Mark Zuckerberg had a chance to answer that question, and he said, it's intriguing, it's interesting, we're going to study it, but we're still spending $65 billion this year in CapEx. I would expect similar responses from Amazon and Google that they'll study any innovations, but they plan to lean aggressively into investments. So I'm looking for confirmation of that. Secondly, any sort of commentary about tariffs. I don't know that there's really much to say. I think both of these companies do have exposure to it. Obviously, Amazon. But Google too, and Meta, and all the large cap names that get money from marketers who are marketing cross-border trade, which is a significant source of revenue, solid mid-single-digit percent of revenue, maybe high single-digit percentage of revenue. So there'll be some impact here. They'll probably talk about it. And third, just overall demand trends, and we think Google will be able to talk positively about ad trends like Meta did. And with Amazon and AWS, Microsoft gave us kind of a mixed read on demand there. Not necessarily better, not necessarily worse, solid, but not necessarily improving as quickly as the market wanted or as well as the market wanted. So the question is whether AWS is going to show similar trends as Microsoft did. We think they will. They did 19% growth for AWS last quarter. If it's 20% this quarter, great. It's 18% bad, 19%, which is what we think it's going to be. It's going to be kind of neutral.
Mark, let's dig into those 3 points and start off with the first one that you highlighted when it comes to whether or not we're going to hear, and very much we're expected to hear, these larger companies continuing to spend at scale on AI. From an analyst perspective, is that the right approach, or does DeepSeek maybe cause you to reevaluate that strategy and that playbook then going forward?
I don't think it causes us to reevaluate it. And if somebody comes up with great efficiency hacks, I mean that in a really positive way, like somebody figures out a way to run these large language models at materially lower compute power, then I think it's a win for these companies, particularly for a Meta that's not selling LLMs, that doesn't have a big infrastructure business. So if you're reducing their costs, it's great for their margins long term. The real question is, as we dig deeper and deeper into this, is just how high is the quality of the DeepSeek language model, and some security problems are starting to pop up when it comes to DeepSeek. So we'll see whether they're real breakthroughs or not. But anything that brings efficiency gains, again, allows people to run these large language models, their AI models, at lower cost, is generally very beneficial for these three companies. And I think that's probably the tone that management's going to give when they talk, both Amazon and Google this week.
Mark, of course, early week and over the weekend, now we're considering how the markets are ingesting some of the tariff talk that's commencing. Does that create a dip buying opportunity, as we certainly have seen this pullback in some of, across the market, but some of the big tech names as well?
We may. It's going to be, depending how big of a dip. The truth is that most of the large cap tech stocks I look at are kind of deep consensus longs. They're at the upper end of their trading range, upper end of their valuation range. The only large cap name that's kind of dislocated, what I call DHQ, dislocated high quality names, is Uber, which actually reports this Wednesday. But the bar is high for these names. The fundamentals have generally been very strong. I mean, these companies are putting up record high operating margins and no real deceleration in growth. It's really, really impressive. Fundamentally, these companies looking to be in a really good position. It's possible the tariffs kind of knock them down a little bit. I don't know if it's going to be a dramatic knockdown. And look, if there were a material correction in these stocks because of tariffs, assuming that they're going to be somewhat short-term in nature or medium-term in nature, yeah, that would be a dip you buy. But you're talking about a dip from kind of all-time high levels here. So to make it really attractive, you need a substantial dip. I hope we don't get that, and I don't think we will either.
Mark, who is most exposed to that tariff risk?
Probably Amazon, just as a company that's so most geared, but not just towards Chinese imports. I mean, so much of trade is cross-border with Canada and Mexico. And so to the extent that that hurts manufacturers, retailers, well, it hurts the platforms that manufacturers and retailers look to sell and to market. So that would be Amazon, it would be Google, it would be Meta. So this will take some time to kind of work its way into the systems. But I'd probably put Amazon as the most exposed of those three, and then Google and Meta probably equally exposed.
All right, Mark Mahaney, always great to get your thoughts and insight here,
Thank you.
especially ahead of a week like this week. Thanks so much for taking the time to join us.